So cash, for example, you could have, but of course funds would not do this because of course they want the investments to grow, but you could have 100% in cash. You could have in your debt instruments like South African government bonds, you could go up to 100%. If it's not South African, up to 75% in your equities, 75% immovable property, 25% your commodities, 10%. There's been a reduction in the 22 amendments from 95% to 65% in your with the home loans, and I know Gandhi actually touched on that as a possible solution for our neighbors in Botswana. But we've actually reduced that because what we noted was quite an abuse of that, of that, utilizing that basically. So that's been adjusted downwards. What has also been done is that we've split hedge funds from private equity funds to encourage investment in infrastructure, because obviously to try to kickstart our economy again after being quite battered, I think, after COVID. So now we have a split between hedge funds, which is provided for 10%, and private equity funds 15%. And then the alternative, in the alternative space, it's quite limited, but it's 2.5%. So as I said, the limits are stipulated in Reg 28, and it's also limited per issuer. So per issuer, if you invest in any one entity, it cannot be in excess of 25%. The other changes that we effected was to provide a definition for infrastructure. As many of you know, Orlando, I think when the industry said that they needed clarity and they needed a definition, he's like, oh, Mara Zarina, but they should know that what infrastructure is, man. But anyway, we obliged and we provided a definition. And in fact, that went through various iterations as well because, there were concerns, I think, with the first iteration. And, but anyway, there is a definition now. We've also increased the limit. Again, this is a signaling. So we increased the infrastructure to 45% because, of course, we want infrastructure investment ideally and more direct investment in infrastructure to facilitate sustainable economic development. So we're hoping, I mean, obviously it's early days, but we're hoping to track that, and we hope that it has the relevant impact. In respect of crypto assets, which I know has also been touched on yesterday, we actually don't allow retirement funds to invest in crypto assets because we consider it to be quite volatile and not as regulated as we would like. And I think there are concerns about what really backs these crypto assets. I've already touched on the housing loans and the per issuer limit. So moving on to the returns on investments, the performance on investments. So of course, 2020, given the impact that COVID-19 had, was not a particularly good year. But in fact, there was really a rallying in 2021. As you can see on this slide, there was significant improvements if you look at the privately administered funds, which we regulate at the moment, there was an improvement of 12.9%, so from 2.1 trillion rand in 2020. In 2021, we saw these assets growing to 2.4 trillion rand. The underwritten funds, not much movement. In our government employees pension fund, in fact, there were also great movements. In fact, they had an increase of 27%, approximately 27%, which was quite significant. In our public sector funds, there was also, so pretty much apart from underwritten funds, across the board, we saw an increase of approximately 17.5%. which really, has resulted in our assets under management being in the amount of approximately 5.1 trillion, which I think is, the almost $270 billion, which I indicated earlier. So just looking at the returns on investments over a slightly longer period, so from 2018, there was a 4.3% increase, but as you can see on the column on, if you look at the column on your right, unfortunately it was lower than the interest rate of, the 4.7%. In 2019, even though it was the returns were in the amount of 5.9%, it outperformed the interest rate, which was great. In 2020, we all know what happened, and in fact, there was just a 0.4% increase on returns or returns on investment. And of course, that was quite low. In 2021, as we discussed, there was a nice rallying, and we saw returns of 18.4%. Unfortunately, those figures couldn't be sustained, and what we saw was a significant decrease back to 5.7%, and which isn't great because our interest rate actually went up to 7.2%. The other challenge that we face is that I think 2023 is not looking much better, to be perfectly honest. Just to give you an idea of what we invest in, as you can see in the pie chart, the major portion is actually invested in your insurance policies, and that's followed by your foreign investment. I know Dr. Farouk was mentioning in Nigeria, they expose, the foreign investment. As I said, ours is, the allowance is a bit higher, and it seems to have a bit of uptake, and you can see that also government bonds, equities, and they also write up their equities, collective investment schemes. So that is really the categories of assets that have the lion's share of investments. So here, this is just a RAND representation of what I've indicated to you, and if you look across the years from 2018 to 2022, you'll see that it's much the same picture. So we have over R1 trillion in insurance policies, followed by foreign investments of 647 billion. And then we have your equities of 431 billion, and your collective investment schemes, 387 billion. So that's pretty much where most of the, okay. Okay, so this is just a percentage, the percentages that are split up. So it just speaks to the numbers again. So as you can see there, the highest numbers really in your insurance policies, the 38%, followed by the foreign investments, which is 20%, and the equities 13%, CISs 12.5%, so pretty much 13%, and the government bonds at just over or approximately 11%. So as I said, Regulation 28 now provides a definition for infrastructure, so there's no uncertainty as to what can be invested in, and there is the 45% limit for infrastructure across all classes, and of course that excludes your government bonds. And as I said, it was important for us to do this as a signaling to invest in infrastructure, because in fact, indirect investments in infrastructure, there's only, South Africa does approximately 2%, which indirect investments, which is rather low. So we did want to signal for more investment in infrastructure, which we hope, does pan out. And as I said, we did this, after suffering from the COVID pandemic, which had quite a deleterious impact on the South African economy. And as you know, it is quite key to actually kickstarting the economy. I think a lot of that was touched on yesterday. And our government, for example, we have announced or has announced an infrastructure investment program of over 2.3 trillion approximately over the next decade. Usually infrastructure investments were funded by the state, but escalating debt, exacerbated by the COVID-19 pandemic, led to the government to turn to the private sector, including retirement funds, to potentially fund infrastructure investments. Okay. The importance of 5 minutes, okay. So the importance of infrastructure investment finds expression as well in the OECD working paper number 13 and in the SDG goals. And the challenges that were identified, I think, may be worth mentioning because it's challenges that retirement funds have also raised in South Africa. They're concerned about the limited data on the size, the returns, the risk returns correlations, which concerns them, the lack of liquidity. You require significant scale. So for the larger funds, they have the ability to invest in infrastructure, but not so much the smaller funds. So it's not a suitable proposition for all investors. The lack of clarity of investment opportunities, and even though government has announced a significant pipeline, when you go to industry or you go to the retirement funds, they've actually said, but they don't see sufficient pipeline. Then it is also political risk, as well as the investor capability, because it's seen as a fairly new area for retirement funds to invest in. The question is, do we have the necessary expertise? Then, of course, the short-termism of investors. Unfortunately, in funds, often it's not, many people don't stay for the long haul, so there is quite short-termism on the part of investors. I think that what has been mentioned are regulatory barriers, but that's not really the case in South Africa. And just the negative perceptions around the value and the investment vehicles. In fact, last week, our minister mentioned that, one of the industry bodies have actually engaged with him to say that the investees, they're not too clear on they want to do it, but they're not too clear on the investment vehicles. And his rebuttal, because unlike, I think, the minister of Zimbabwe, he says, I've been organizing workers to strike for 20 years. You must tell me what investment vehicles you consider to be particularly useful. But of course, we will engage the industry, and come with certain recommendations. So moving on to now the trends in foreign asset allocation, as I said recently, and as recently as on the 23rd of February of this year, we basically increased the foreign asset allocation. And it was basically just to, for purposes of diversification. I think what the industry came back to us with and to Treasury was that, had they had greater offshore investment, for example, they might not have received the pummeling that they did, during the COVID pandemic. And so there was really a push to increase, and it was basically taken on board. What we also did, as you may know, previously we had a 30% offshore with 10% in Africa, but then that was done away with just to basically have a 45% offshore. So it didn't particularly matter where it went to. In any event, what the industry has also indicated is that that this is not a driver for offshore investments necessarily, and that the optimum amount that will, in all likelihood, go off is between 38 to 40%. At the moment, in fact, when we just did a quick synopsis of some of the funds, they're hovering at around 33 to 34%, which is not significantly more than was invested offshore previously. But of course, we'll watch the space because it is early days. And just the decisions that, or why funds wanted to invest offshore, it was, as I said, the need for diversity. as I think with Nigeria as well, we have a declining number of listings on the Johannesburg Stock Exchange. The forex return of offshore investments, which is mainly in pounds, euros, or dollars. The performance of the foreign assets has generally been relatively good. And of course, investor demand has also driven this. Then on ESG factors, as I've indicated, Regulation 28 promotes responsible investing of fund assets, and funds must have regard to ESG factors when they invest. It must be contained in your investment policy statement if you're a fund, and you must look at whenever you invest in any asset, you must look at your ESG factors. This we followed up with a guidance notice, 1 of 2019, which basically just gave more meat to Regulation 28. It also provided for certain reporting requirements, but as may be seen, it's a guidance notice and it's not legislated, but the legislation will follow, because we will be issuing a conduct standard during the course of this year to make it compulsory to do certain disclosures. And during 2020, because this is quite a nascent area for us, the ESG, but we've done a survey of retirement funds, just to basically see where they were at in respect of sustainable finance practices. And some of the results that may be of interest to you is that that most investments in infrastructure, this was done through indirect investments. I think there's no surprises there, through external fund managers or your funds like infrastructure funds. So 37%, for example, was done in this manner. And again, no surprises in indirect investments. Only 9% of the respondents indicated that it was direct investments. And as I said, that's even still large, because I think in overall, it's actually only 2% indirect investments. Another interesting observation from the survey was that they typically invest in roads and rail. Again, I think in our context, not too surprising. But of course, there's also investment in student accommodation, etc. But road and rail remain the main, that's where we mainly invest in, those infrastructure projects. The utilities, or the utility scale of renewable energy generation investments. So it's mainly in wind, because as those of you who have been to South Africa, you'll know that we have lots of wind. It's quite windy, Northern Cape, Western Cape, Eastern Cape. So there's a lot of that, as well as in solar. So those are the areas where most of the investment in renewables actually take place. So the rest, I think I'll leave it there, because the rest, I think you can look at the results. I think it's quite interesting. But yeah, I think at your leisure, feel free to go through it, and I'll be happy to take any questions. Thank you.
Thank you, Zarina. So the presentation is longer, and then you can digest slowly the annex with all the information, and also we can follow on that at the question and answer session. I just wanted to say that as IOPS, we are working on several related projects. We are doing now some analysis of what the pension funds are undertaking and how does it look with the current regulation. And also we did a paper on the infrastructure, but it's getting a bit late, but old, but it shows that actually South Africa at that time was already a leader in the investment in the infrastructure. So I think that this is a very good and interesting example. So let's go now to the presentation by Dr. Domenico Fanizza. Thank you.
Okay. Good morning, everybody. I would like to start by thanking the IOPS team for inviting me, and in particular its chair, Ambrogio Rinaldi, for this invitation, which I was very happy to receive, and of course the OECD colleagues that, on which we have been in touch. Let me start. How do I start the presentation?
Go up, so
Okay. Okay, so let's not waste time until it comes out. What in this short talk, I will try to answer to the question that you will be seeing on the screen shortly. Actually, it's there. The question is whether Africa can be thought as a fertile ground for pension funds. As you can imagine, this is a rhetoric question. So the answer is yes, it is. Why? Let's say it is both in terms of liabilities, the contribution basis, and in terms of the, no, can you hear me? No. And in terms of the asset size, investment opportunities. Let's start with the contribution base. Now, here I should tell you that I really don't like PowerPoint presentations. And actually, I like to say, and I see the presentation as an opportunity only to show slides. And of course, when I prepare, okay, very good. Well, you know, I'm not young. I've been in this job, in this business for a while, not exactly pensions reform, so I should know how to do it. But I mean, one of the issues of sending a presentation is that when you write the things that you want to say, actually you change your mind and then you organize it in completely different. So very likely I will jump around the presentations if you allow me. So we were saying the contribution basis. Well, you have already heard this figure. Only 8.5% of sub-Saharan Africans have pension coverage compared to 32.8% globally. So we are really behind. You know that. And what is the main reason for that? Is that this reflects in part high level of informality, very high level. I mean, yesterday also the Minister of Finance Excellency and Thuli mentioned clearly that less than 20% of employment is formal in Africa, in sub-Saharan Africa. When I talk Africa now, I'm talking about sub-Saharan Africa. And that includes government and state-owned enterprises. This means that actually the real formal employment and formal activity is negligible. Therefore, this has consequences. If you think about a sustainable pension system in Africa, the contributions do not come from broadening informality, but come from the informal sector. You have to get informal people to participate. And that's the big challenge and also the big opportunity, as we will see. Nevertheless, the coverage has been growing fast, much faster than one who could have imagined. Nigeria doubled the asset under management, the pension funds, I can't remember of the name. It's between 2016 and March 2023, it more than doubled to reach the equivalent of $16 billion dollars. A lot. And in actually, you see that on the graph. So there is a huge potential there. The continent, unique, favorable demographic, and then we have to go fast here. Look at that. I'm sure you're familiar with this picture. The pyramid, no? So the continent unique favorable demographic profile points not only to a fast expanding working population, in other terms, potential contributions, but also an innovation-prone population. You do not teach new tricks to old dogs. Young people are much faster than me in doing anything. So that's the strength of the continent. So young population are more active in digitalization. The contribution base can be broadened, leveraging digitalization and high mobile coverage of the country, but not only that in a sense, young and digitally savvy people are more prone to implement innovation, and therefore this has immediately an impact on the capacity of produce investment and improve productivity. It's a major opportunity. So this profile implies not only that the contribution base will expand fast, but also that investment opportunities will grow proportionally too. And that takes me to talk about the asset base. Now I have to go back I think. So what are the investment opportunities in the continents? The basic message, we already we are talking about infrastructure. I don't like to give you these figures because they are completely, I don't know what it means completely, but the African Development Bank estimates that the annual infrastructure funds needed are between 70 billion and 110 billion per year for the next 10 years. And that's a huge amount, okay? This is really an incredible gap. And there is something clear. I don't know whether this is true because those figures are, but we know that it's big. But the main message is that without domestic savings, you cannot even think of filling up the gap. Aid flows cannot do it. Actually, they are reducing that. Foreign flows, our private investment flows are welcome, but they cannot. You cannot imagine that they can do the whole job. At the same time, public resources cannot do it. So this is why pension funds, your business becomes very, very important to make sure that the continent is transformed. The resource, because pension funds becomes the key factor in developing deep financial markets and help filling the gap. Now, infrastructure investments, we have already mentioned that, are part of what we call alternative assets. Those include, depending on the jurisdiction, infrastructure, green bonds, green bonds, private equity, real estate investment trust, and things like that. Okay? It is clear that there is ample scope for increasing the proportion of assets in African pension fund portfolio, even as we talk now. These are some figures that show that it's very, very small. You can do much better. And the other important message is that this has nothing to do with regulation. Those are regulation ceilings in several jurisdictions, and you see that actually the alternative assets are well below that. This is confirmed by a recent survey done by the IFC, by the African Development Bank, in which they went to you people, pension funds in Africa, and asked what is going on. They said, no, absolutely. The regulation is not the issue. The real issue is bankable project. How do we make sure that we identify the right? Okay. So that's the background. So how am I doing with time? Already done? No. 5 minutes. So, well, no. The things that I would like to say now is that what the African Development Bank does in order to help identifying bankable project. There is one area in general that tries to develop institutional settings in countries that facilitate deepening of financial markets, and that's okay. I will not go into details, but I will then the bank has some priorities. For instance, the first one is Power Africa. You must have heard the high five. Actually, I like to think the high four, because the fifth is a portmanteau variable, let's say, where the idea is that we want to achieve universal electricity access by 2030. This would require large investment. The objective is building robust and interregional power systems that were collected. So this will go hand in hand with the green revolutions, green power revolution, which it's a major opportunity. The second priority is Feed Africa, developed an agribusiness model in which the untapped potential of agriculture in the continent is fully exploited. Then the other priority is industrialized Africa, which means not building smokestack, let me be clear that, but actually, for instance, developing information and communication technology, focusing on connective infrastructure to help and support digital entrepreneurship. And then integrate Africa, build infrastructures that can help build a regional and interregional markets, which is the way in which the transformation on the continent can happen. So those are the broad priorities. How do we do that? The bank has limited resources, and they are identified. There are projects which are identified, but what we are trying to develop are risk mitigation products that can help and mobilize more resources from institutional investors. Those include private risk guarantees, partial risk guarantees, straight guarantees. And those is what actually we believe is important. That's the way in which actually we leverage the bank's scarcest resources to get more investment in the priorities we have set. And this is why, for instance, example, the Lake Turkana wind project has benefited for a guarantee of this kind. The privatization of the energy sector in Nigeria, similarly. The expansion of the Air Cote d'Ivoire has done the same. So those are examples. And finally, I want to give you another example of works that we have done in these areas that might be of interest, which is the AB loan structure, where, let's say, the bank identifies an infrastructure project worth financing. For instance, a concrete application was a Trans-Gabonese highway, which is not yet realized, but is one. How does it work practically? The bank approves the A loan. At the same time, identifies an institutional investor, a pension fund, who's interest in the loan, but wants to limit its risk exposure. So it issues, let's say, there is a loan from the institutional investor to the bank, practically, where the institutional investors benefits from the AAA rating of the bank, and also for the preferred creditor status of the bank. So there are growing interest, even in Europe, about investing in Africa development. This is a simple way in which the risk can be managed and limited. I think I've talked too long. I hope I've not bored you. And thanks again. It has been a pleasure being with you.
Thank you, Dr. Fanizzi. So now we will have the third speaker, Mr. Patrick Kariuki from the Pan-African Fund Managers Association. Please, Patrick, the floor is yours. Thank you.
Thank you very much. I would like to ride on all the protocols observed, and Deputy Minister, thank you for sparing time to be with us. I would just like to make a minor rebuttal to Dr. Faniza after his excellent presentation. Yes, it is true in Africa we have got 8% pension cover, but long ago it used to be close to 100%. And I'll explain why. Because we used to get many children, and those children would look after us when we were old and retired. So, not sure how. Okay. Yeah, so my presentation will just go very brief to keep within the time allotted. I'll tell you about PAFMA, Pan-African Fund Managers Association, and also the Fund Managers Association of Kenya very briefly. I'll take you through the East Africa Pension landscape, but focus majorly on Kenya and look at what are our key challenges and mitigations and the future. Where do we see that youth bulge that Dr. Faniza aptly took us through? What are the opportunities there? And I'll give you an example of how we can use innovation and technology, a practical example that has been started in Kenya in order to increase pension coverage to the downtrodden in society in Kenya. Yeah, so about PAFMA, I'll just take you one step back. The Fund Managers Association of Kenya began in 2008. It was formed by three CEOs then who just meet of various fund management companies over coffee and discuss common challenges, and this led to the creation of the Fund Managers Association of Kenya. We received very good support from our regulators, Retirement Benefits Authority of Kenya, Capital Markets Authority of Kenya, and today our members control 80% of retirement assets in Kenya. Its objectives are very simple and still remain to actively engage policymakers, regulators, and other stakeholders, and we aim to become an SRO in future, self-regulatory organization, to have common investment performance standards, to have a forum to exchange ideas and network, and promote investor education and new investment products. Hence, when Pan-African Fund Managers Association was formed, it echoed with us very well, and we saw that we can collaborate with other fund management associations in Africa in order to come together for all our mutual understanding, and we aim to be the IPOS for fund managers moving forward, not only in Africa, but in future we can have an international umbrella body. We are a new baby formed in August 2023, and I would like to also introduce a colleague, Mubale Mugala from the Investment Management Association of Uganda. Maybe if you could kindly stand and just raise your hands, and hopefully in the discussions that you can make a comment or two. And again, the similar reasons for formation: to network and learn, experience sharing, find solutions to common challenges, capacity building and collaboration with global institutions, and also to help exposure to non-traditional alternative investment areas. So I think I've spoken a lot about this slide. I'll just take you very quickly through it. So far we had the founding members: the Pension Operators Association of Nigeria, Fund Managers Association of Kenya, Botswana Investment Professionals, Ghana Securities Industry Association, Investment Manager Association of Uganda, and then we have recently been joined by WAMU, West Africa Fund Managers Association, and the Morocco Fund Managers Association, and we are grateful for Financial Sector Deepening FSD Africa, who have been our sponsor and helping with setup and institutional capacity building. So just turning to East Africa, yes, pension coverage is low and it is inadequate in the East African countries. The assets under management, while still growing, are predominantly in government securities, as I'll take you through. And the size in Kenya, we are 112 billion USD, Uganda 6 billion, and in Tanzania there are two funds: the National Social Security Fund, which is for private sector, and the Public Service Social Security Fund for the public sector. Now in Kenya, turning to Kenya, where are pension funds allowed to invest in and how much of it have they utilized? We are allowed to invest up to 90% in government securities. The actual investment is actually 48% as of December 2022. Quoted equities, we are allowed to invest up to 70%, but we are actually at 10%. It has been reducing down from 20% due to the poor performance of our stock markets. Immovable property, the maximum allowed 30%, we are now down to 15%. Insurance, guaranteed funds, deposit administration, schemes are allowed to invest up to 100% of the assets. What has been invested is 20%. Now, when we come to listed corporate bonds, schemes are allowed to invest up to 20%, but they've only invested 0.5%. Bank deposits, fixed deposits, 30%. Investment is actually 4%. Offshore is an interesting place. We do not have exchange controls in Kenya, although schemes are only allowed to invest up to 15% of their portfolio in offshore pooled vehicles, but the actual investment is 1.4%. But there's been a lot of interest of late because of our decline in Kenya shilling value. And then on unquoted equities, 5% is a maximum allowed, but schemes have only invested 0.3%. Private equity allowed up to 10%, schemes have only invested 0.32%. And also in alternative investments, we allowed up to 10%, but less than 0.02% has been invested in it. So what has been happening? Why haven't we been investing in it? I shall come to that in the slide after this. But the investment performance, on average in the last 10 years, has been an average of 10.38% with fluctuations over the years. Last year, the performance was 1.7%. This year, I think it might end up around 1% due to what's been happening in the global markets and also our mark-to-market challenge, which I'll expand on it. So we see on pension there are leakages in some of our countries in East Africa. In Kenya, one can access up to 40% to take a mortgage of your pension savings. But this has not really taken off because of tax challenges, because what the taxman says that we gave you tax exemption to save for pension. So why are you accessing it early? So I have to tax you on that, and the takeoff has not been good there. And in Uganda, the response to COVID, there's been mid-term access to their National Social Security Fund. But we have an untapped, youthful and growing population. In Kenya, we are 54 million, 37% below the age of 14. I'll repeat, 37% below the age of 14. Uganda, 47 million souls, 44% below the age of 14. Tanzania, 65 million, 43% below the age of 14. So there's a lot of young people, very digitally savvy, coming up. Yes, unemployment is an issue, but how can we get them some form of pension coverage and then slowly grow them throughout their working careers to make sure that pension is adequate? I think that is a challenge for us, all of us, and it's not down to any particular individual or group. So what are the key challenges we've been facing in Kenya? It's the bond valuation challenges. Our interest rates have been climbing. They have risen from 11% long-term bonds last year up to 18%. And we are required to mark to market. And this really dampens the investment performance. There's a lot of member education needed, because how do you explain to a layman? They can see the bond is earning 12%. Cash is being received, but you're telling them the value is less. And then also in Kenya, we find that the trustee board are split half-half. Half are sponsor-dominated and half are member-elected. And at times, sadly, you can find the most popular person is elected to become a trustee, and they can only serve 2 terms of 3 years. So that also makes them fairly short-term in nature. What they just say, just give me a decent return during my tenure. I don't want anything exceptional, but I don't want to face the wrath from members when investment performance is fluctuating. Another challenge we have is compliance. And I would say here it's not compliance from our primary regulators, but compliance in the legal landscape and changing laws in the country. In Kenya, we have the public procurement and disposal rules, which guide how you can appoint service providers. And this, the industry players appealed against it, went to court, but lost because it was ruled that pension schemes are public in nature and have to follow the public procurement laws or change the law. And there are a lot of new emerging legislation. We've got some from the Institute of Human Resource Management saying that all firms must have a qualified HR manager. We have some proposed amendments to the Employment Act, which even now say that that an employee has the right to refuse to be contacted outside set working hours. What do you do as a fund manager when there are markets really moving rapidly? To overnight, we've got data protection to comply with. ESG is a very hot topic, and a lot of local authority licenses, a lot of tax changes, health and safety. And then there is an authority, Unclaimed Financial Assets Authority, which state any unclaimed pension assets should be handed over to them to do reunification with the eventual owners. So how do you define what is unclaimed? Is it when the person doesn't show up at the retirement age, or when? And then also we have the fees challenge. Fees have been dropping over the years. This has an impact on capacity, long-term returns, and technology improvements. And then also comparing performance between various schemes, because each of them has got different investment policies, and each of them has got different characteristics and also risk thresholds. And then the tax challenges, yes, I will acknowledge that there are a lot of exemptions for tax, but at the time of actual retirement, under most circumstances, there is taxation levied on it. So what are the opportunities? We have our main National Social Security Fund Act, which passed in May 2013. That's when it was put in law, but there were a lot of legal challenges. But finally, it was allowed by the courts in May 2023, even if there is an appeal to the Supreme Court on it. And in it, this will increase over time the actual contributions going into the state pension scheme from $2 to about $50 over the next 4 years, a 25% increase. And it has two pillars. One amount, it is mandatory, but the second amount you can put into your private retirement scheme. And then the other opportunity is we have seen the funded public service pension scheme. The last 3 years, they have done all of the funding for it, and that is an opportunity also growing. And then we've seen a lot of innovations using mobile technology, and we have seen moves towards giving the members choice, not a one-size-fits-all. And we have seen a lot of debate. Shouldn't we have a save as we go? Shouldn't we have a sales tax, a pension tax, which is put on all goods and services sold? And so that when you acquire something, a portion of that sales tax goes towards your pension scheme. But we have a classical example, which is called the K-Nest, which is called the Hustler Fund. It is an example of innovation. Last year we had a government in place, and they are very keen on helping the downtrodden in society and helping them save, and also save for long-term pension. So it was set up by the government, and with World Bank support, it's a digital financial inclusion designed to improve financial access to responsible finance for personal, micro, and medium-sized enterprises. It lends through the mobile phone to business people. It lends micro amounts, and as you repay, you can access more and more. So it actually lends amounts from $10 up to $50. And the interesting part here is that for every dollar lent, 5% of it is withheld and credited to the borrower's savings account. 30% of it goes to short-term savings, and 70% of it goes to a long-term pensions. Yes, these amounts are small, micro, but they can be built up over time. Approximately 214 million USD has been lent out, and of that, 5%, 1.6 billion Kenya shillings, 106 million is in the borrower's account for savings and pension. Sorry, that should read 10.6 million. And there are a lot of teeth in pains, funding, repayment, bookkeeping, but the opportunities are very many here. So I think if we all put our heads and we can become innovation and using the mobile technology for the fund here, all you have to do is just press *234# and you will be able to join and be able to now borrow, and as you increase on your repayments, then you can access more borrowing. So I'd just like to stop there because of time and end with an African quote that even the best dancer must retire sometime by Lalma Ella. Thank you very much.
Thank you, Mr. Kariuki. So as we can see, we will start the questions, but I want to have my own part, otherwise you will say that I'm not doing the job as a moderator. So we see that there are some couple of key things evolving that hopefully we will be able to discuss at the next session. So the coverage issues will be covered in the next session, and the things that you discussed about the trustees, for instance, it's a subject of session 5, so probably we could keep these themes for our colleagues. Myself, I have observation. Yes, you mentioned that there's the issue of mark-to-market, and bearing in mind that most of the African countries, they invest dominantly in bonds, that is an issue. And I have a very good friend of mine working as a statistician in the OECD, and he says, you know, when you will be here, can you ask those people, how is it that you have, okay, how is it that you have the bonds portfolios, you had the interest rate increases, and yet I still have the positive, at least nominatively, returns for the last year. So this is interesting thing. And what we've been seeing, that there was some kind of movement towards changes of the valuation. And I think that that might be interesting for the regulators to consider if the long-term bond portfolios might be treated as a simply held to maturity and then be immune from the changes in the interest rate. So the second thing, yes, the coverage is the issue. Perhaps it is quite difficult to use the classical contribution-based system for the informal economies. And you mentioned, I like the expression save as you go, and then I was thinking that probably you could think about this micro savings, which might be called like pay as you spend. So when you go to the shop, a micro portion of your expenditure is being saved in the retirement account. So instead of trying to have the access for the contributions from the salary, from the income, you can try to have access to the contributions from the outcome, from the spending. With this, I think it's time for me to stop. I would like to invite you to ask the questions I will raise, and I will see who's interested. Yes, so can we do the technical arrangement as yesterday, that everybody would stand up and say shortly who's representing? And I have one question here from Ambrogio. He's the president, so I think we can give him the privilege to be the first. And then there are two other questions in the end of the room. So let's start with the first question. Thank you.
Thank you very much. Well, thank you to all these speakers. I found very inspiring this session of the conference for two reasons, I would say. One, actually, that also may have an impact on our program of work, I would say. Because one thing is, first of all, that it is clear that Africa is, how it was said, a good garden for investment, for long-term investment. there is a lot of potential, and obviously this potential is important for African pension funds, for the investments of African pension funds, but also for the investments of pension funds from all over the world. Also the very big pension funds that we have in Europe, in the US, everywhere, probably look at Africa, and I was wondering how much they have in their portfolio. We actually did not collect that kind of data, and I was thinking that when we organize meetings in different regions of the world, it would be interesting to do that kind of research in advance in order to discuss issues also from both point of views, from the point of view of the interest of also of the pension funds worldwide to invest in the areas in which we go. And the second inspiring point is that more related probably with the presentation from the African Development Bank. There is a clear common view and interest between us, between the regulators of pension funds, the supervisors of pension funds, and the development, the regional development banks in terms of fostering long-term investment in infrastructure, for example. And probably we may even, I just put this on the table for maybe for some future dialogue. We may even think about some common program on that could look at how pension funds could cooperate in somehow or in co-financing, at least in looking to regulation and supervision, how it can be maybe made more friendly in terms of fostering investment, also by and with regional development banks. And on that, I would also ask, in particular, Mr. Fanizza, if in your experience you did already identify some aspects of pension fund regulation or supervision that has a specific impact on the capacity of building in cooperation in investment, co-financing of investments in Africa. Thank you very much.
Thank you, Ambrogio. I think that we can take 2 or 3 questions and then have the ground for the conversations. So, Mr. Minister, you have a question?
Yes, thank you. I thought I would save the nice lady a trip up and down since the mic is already here. My question is for Zarina in particular, but anyone in the panel can feel free to answer. And I ask because South Africa is a resource-rich country like Zimbabwe. Now, a lot of our presentations are a bit silent when it comes to category on your mining and agriculture, but we glean on the infrastructure. The biggest growth in our country, Zimbabwe, has been in the mining and agriculture sector. It's a resource-based country. You find a situation where, because of the historical risk that has been attached to these industries, our pension funds are a bit weary when it comes to investment. Henceforth, you find yourself investing in bonds related and to PEs related to that. Zimbabwe is going into an area or a territory where we might become the largest lithium producer in the world. And our pension funds are playing wait and see while the miners are coming in, the processors will come in and start creaming it. My question for you, Zarina, is as South Africa regulators, have you come up with somewhat of a best practice on how your pension funds can participate in this area? while still preserving value. I know we've got a discussion around the ESG and the green revolution, but in an African context, would want to see our pension funds participate in the areas that have the largest growth so that we can catch up on the mismatch between our obligations and our assets. That would be the first leg of the question, if there's a best practice in your regulation in South Africa. And then the second part would be, should it be the regulator that leads in coming up with a framework that would then allow our pension funds to participate in these areas more actively, whether it's a short window or longer, or is it the industry itself that should be identifying these areas and then bring it up to the regulator? Thank you.
Thank you. I can see that we already have a big bank of questions, so maybe let's try to process them before we get the new ones. So I think that one question was to Dr. Fanica and then Zarina. Thank you. Of course, all of you can intervene on particular question. Thank you.
I think there were two questions, okay, for me. Unfortunately, on both of them, I'm going to give very general, possibly answer, but comments, I would say. The first one is that, of course, we can collaborate institutionally. Of course, more than welcome, actually. We can explore, and I'm here at your disposal to facilitate the process. And you will find, I think, enthusiastic reception at the bank. So that's the second one on the particular changes on regulations. Unfortunately, I'm not an expert of pension funds regulations. But I think the message that I was trying to give at the end of my talk is that the bank can work with pension funds in order to de-risk investment with a number of products that I've listed in the presentation. And that's something the banks is very keen to do, because what we were saying before, our resources, government resources, aid flows cannot do the job. We need to mobilize private sector. The private sector is the key to the transformation of the continent and to the financing, the financing needed to fill the investment gap. And of that, on the concrete aspects, we can discuss and we can find opportunities to do it. That's all. Thank you.
Thank you. So now I'm giving floor to Zarina and Patrick. Thank you.
Oh, okay. Sorry about that. So, Deputy Minister, thank you very much for that question and for being in attendance. Sorry, I didn't acknowledge you earlier. So we don't have a best practice, as a regulator, because we have the categories of assets in Regulation 28, and then, as I said, we don't have prescribed assets, as was the case under apartheid. We have the maximum limits or maximum limits. So it's within that framework where funds actually have a lot of room to move. But I take your point. I mean, if there are huge growth points, I think it will be very useful. And I mean, it is a point I actually wanted to make earlier. I think that we probably don't engage enough, which I think is a point that the minister alluded to yesterday. I think there should be more regional engagement potentially to see what we can do to actually maximize investments where it needs to go. Again, we won't direct it and say, as I said, because we've shifted away from risk investments um, a long time ago. But at least, again, I mean, if it's useful, if it's going to be beneficial to members, we can certainly do certain signaling. I mean, but again, and we can recommend, Minister, but as you know, in our case, it's actually we make recommendations, but it's the National Treasury that will ultimately make a decision in this regard. But I do think it will be great if we can actually have more engagements and constructive engagements, because I think it will also, I mean, even to Patrick's point, you know, and it's very sad, I think, when, you know, Dr. Vanitza, sorry, when Dr. Vanitza spoke about the low coverage that we have you know, on our continent. And even though the picture is slightly different for South Africa, I think it's important that we, you know, we actually work together, we cooperate, we collaborate, we synergize, so that this picture can look very different, you know, having regard to our, obviously, our material conditions i- i- on the continent. But I'm happy, Minister, to summarize, to, you know, to have further engagements on what you've raised, and, you know, we can do it with the Zimbabwe regulator as well, and see what we can come up with, and as well with our national treasury. Thank you.
Yeah, thank you. And I would also just like to thank Dr. Finitsa. What you've said is actually a lot of music to the Fund Managers Association's eyes, that you can help de-risk certain investments, and we can also participate early enough to tell you what sort of structures can also help pension schemes so that they can still be able to meet the short-term needs and long-term needs of members. So it's music to our ears. Thank you.
Thank you. And from my side, I just want to advertise that our OECD colleagues also did some work on the due diligence related to the mineral supply chain. So it might be also of use as a point of reference for your internal discussions. Let's go with another, let's say, 3 questions. We can stretch a little bit the coffee break because we still have plenty time in lunch. So I see one question okay, let's do the following. There's one question at the end, and then I see 2 questions here in the middle, and the last question will be Hong Kong. Oh, so if you can be very quick with the questions, I can get also questions from the gentleman over there. So let's go first the end of the room, then here the middle, then we go to the gentleman, and we will finish with Hong Kong. And that will be all 4 questions. Thank you.
Okay, thank you very much. My name is Lawrence Ngube from Zimbabwe. My question is directed at the presenter from Kenya. I got attracted by the board composition. That is got employer appointed and member-elected trustees.
Sorry, can you just keep your mic a little bit closer? It will be easier.
Thank you.
Thank you.
Thank you very much. When I got attracted to that, I got disturbed as well. If I got it right, that the member-elected trustees most of the times go to those people that are popular within the workplace. Whilst I think best practice world over is talking about education, educating, you know, the members when we talk of financial literacy. So I wonder why we would talk about financial literacy of the members and then allow these political clowns at the workplace who want to push themselves into representing members, yet they don't have the skills to understand when, you know, financial risk issues and all those things, investment policies are discussed at board level. So my question was, what are regulatory authorities doing about the influx of such, you know, people that go into the boards of trustees? Perhaps this question would also go to my colleagues in Zimbabwe to say, when we do elections for board members, most of the times, no matter how much you tell members that this is not a union business, you still see members pushing people to the board, even if they are going to sit on COPs, you know, certificate of proficiency in pension funds. I think it's just a basic qualification. But I'm happy that in Zim, I think, if my memory is okay from, you know, reading, I'm sure we're most likely going to up the skills of board members. I will end there. Thank you very much.
Thank you. Due to the time constraints, can we park your questions for the session on the trustees? It will be, I think, excellent question to consider. So about the issues of the quality of the representation. And let's go to the next question, which is in the middle. There are two gentlemen, but please be short, okay? Thank you.
Thank you. My name is Kotsaga Amenge from Botswana. I'm on the board of the non-bank Financial Institutions Regulatory Authority. I'd like to forward my question to South Africa. It is the question of crypto assets. I want to ask South Africa about crypto assets not being allowed in South Africa. Is South Africa adopting any international standards? I'll give you a typical example like the ISO 27014 on information security governance. Is South Africa adopting such so that crypto assets can be taken into consideration? Thank you.
Okay, let's with the second gentleman.
Thank you. My name is Enmo Taruinga from the Securities and Exchange Commission of Zimbabwe. I've got two questions directed to Zarina and Patrick. The first one probably to Patrick. You made a reference to a race for lower fees having an impact on pension funds. Probably if you could clarify how fees have got an impact on the pension funds. And then my second question, I also observed from the two presentations that there's a relatively lower limit on property, or is it immovable assets compared to the other asset classes. So the context being that back home, we seem to have a larger limit on immovable property. I just want to understand why there's that lower upper limit on immovable property.
Thank you. Was this question clear to you? Yes, okay. So then let's get the last two questions. Thank you.
Yeah, my name is Martin Anthony Nsovga from Uganda. Just a quick question to Zaren. You mentioned about the housing loan to members. How is this executed, especially when a member ideally is given the opportunity to access this money? And then with the controls that are likely to be there in terms of measures on the tax bodies, which a case I think we saw from the presentation from Patrick, and the risks that are embedded therein. Is there recoverable that we can be shared with?
Sorry, I can see that we cannot hear you. Actually, I was wondering yesterday, but now I'm on the stage, the volume here is quite bad, so you need to be like an actor for us.
Like an actor, okay. Okay, let's just a deep voice. Just a question on housing loans that you mentioned as one of your asset categories, which is issued to the members. So the question is, how is it implemented where members are given access to this money? And then it's my money anyway that has been given to me. What is the motivation to even come back and pay back this money? And also with the controls that normally there from the tax bodies, and I think we saw a submission from Patrick about it, where the Kenyan case has failed to take off. We have a similar case, but it is implemented differently. So I'm just interested to know whether there are some positive recovery rates or there are even defaults in that case, and how it's being assumed within the scheme. Thank you.
Thank you, Martin. And the question from Yang Chen? Oh, no, it's from some. Okay.
Hello, hi. This is Samuel Lam from the Managed Reporting Fund Schemes Authority from Hong Kong, China. I have a very quick question also for Serena. understand that from your presentation, it mentioned that like around like 40% of like the South African pension fund is invested into like insurance policies. And may I know the reasons like and the underlying factors that why is it the case? Thank you.
Thank you. So it seems Zarina is having some overwork here, but I think it's because of your pension funds. They are too active. So please, who wants to answer first? Okay, let's start maybe with Zarina, and then we will see how the answers go. Thank you.
So to my neighbor in Botswana, on the cryptos, we are, as the FSCA, trying to regulate cryptos, as you may know. But as far as pension funds are concerned, we are trying to take quite a conservative and prudent approach. So at this point, we aren't really considering allowing investments into crypto assets. I think that was the question by Botswana. And the second question was on, sorry, I can't remember now who was second, but I know there is the question on, what was the other one? Oh, sorry, I forgot. On the housing loans. Oh, the housing loans. Sorry, I wasn't too clear on the housing loan issue. Are you asking about how the housing loans will operate now that we will have the two-part system? Yeah, okay. So look, I mean, if it is that your housing loan is exceeds that amount, then the simple answer is that you won't be able to basically get access. Okay, so it's only if it's in excess thereof that you'll be allowed to access. And look, there hasn't been, from what we've seen, there's not been many defaults. And basically because it's asset, it's a pension-backed lending, we haven't had many challenges because, I mean, obviously if you default, then, whoever stands guarantee, or the banks will basically take your pension benefit, essentially. So I don't know if that addresses your question. On Hong Kong's question, I couldn't hear it too clearly either, but I think you asked why is it that our investments are considerably high in insurance. So I think it's because the returns have been pretty significant. And remember, it's insurance policy, so it's a wrapper. So it could be, it's a wrapper for ETFs and many others. And I think because the results have generally been quite good, that's why there's been quite a bit of exposure to investing in insurance policies.
Okay, yes, thank you. I appreciate the question on trustee board. I think the reason why that we had introduced member representatives, because initially pension schemes were very tightly controlled by the sponsor, by the chairman, MD, and finance director. And this was just to ensure that the moves from DB schemes to DC schemes would get greater acceptability. But I think now the way forward might be to tighten the trustee rules, skills, experience, maybe insist before that they can stand for elections, that they should have passed some fairly stringent trustee certification course, maybe even look at having a corporate trustee work alongside the actual boards of trustees, because there is a lot of turnover. So after a period of 10 years, people don't really remember what happened because all of the initial trustee board has changed around. On the comment of lower fees, how it can affect performance, and I say can affect performance because you will find that there are certain alternative asset classes where you need to really employ suitable, well-skilled professionals, and these people are not cheap. And so if you cannot be able to employ them,
at times you will get some of the smaller firms shying away from actually looking at these alternative assets. And just a final comment, there was a time many years ago I wrote an article that pension is for pension and there should be no leakages allowed, and I received a lot of flack. So on this area of leakages, I now tread very, very carefully. Thank you.
Thank you. Just in case any question that was asked, anything missing, or we answered to all the questions? I see that gentleman is still a bit unhappy, so maybe let's try again and see whether this question is to be answered. And that will be the last question. And then I think that it would be good if we have the coffee break ending at the scheduled time, which is 10:30, and then we would be on time with the other sessions. So let's ask the last question. Thank you.
Thank you. I didn't quite hear a response on the link between fees and the pension funds. And also, perhaps it was answered in terms of the returns, why the relatively lower limit to property in relation to other asset classes. Yeah.
Is
Maybe
it the
I can
same?
answer it if you'll allow me first and then hand to Zarina. I think if I heard right, you are asking why these days there is a lower allocation to the real estate. Yes, I think from our end, it is because historically schemes had been overweight there. And as they moved from DB to the DC schemes, some of them faced a lot of liquidity challenges. And there is also a move to try and discourage schemes from direct investment, but to go through pool vehicles, which give them one diversification, and two, some form of liquidity. But I think, Zarina, the question was more to you.
Okay, thank you. And I'm sorry for having missed it. I forgot my notebook. And that's why I couldn't note or jot down all the questions. So I seriously doubt that we will increase that. What we have seen as the regulator around investments in immovable property, there's been quite a bit of corruption, if one can say, can call it that, around it. So, but I know it has served certain funds quite well in terms of obtaining good investment returns, but I don't think we'll go to the higher level because of our concerns that, associated with corruption around investing in the immovable properties. I think we'll keep it at that for some time to come. Thank you.
Thank you very much. I'm afraid we need to conclude this session. So I would like to thank our speakers. Thank you very much. Maybe we could do a little applause. And please enjoy your coffee break, which will be slightly shorter, but then please come back at 10:30 so that we can start with the next session. Thank you very much. 11:30, sorry. Yes. Thank you.
Just imagine we woke up in paradise. Don't need magic. Let my thoughts just carry us home, home tonight. Future's golden. Don't let go, don't give it up. Just keep holding. Even when you've had enough, I will be your light. When you're low, I'll lead you home, chariot. Take you back to where you're from, chariot. One step forward on the road ahead of us. Don't look back, no. You just need a bit of luck. Oh, oh, tonight. When you're low, I'll lead you home, chariot. Take you back to where you're from, chariot. When you're low, I'll lead you home, chariot. Take you back to where you're from, chariot. Yeah, 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 When you're low, I'll lead you home, chariot. Take you back to where you're from, chariot. When you're low, I'll lead you home, chariot. Take you back to where you're from, chariot. Just imagine we woke up in paradise. Don't need magic. Let my thoughts just carry us home, home tonight. Future's golden. Don't let go, don't give it up. Just keep holding. Even when you've had enough, I will be your light. When you're low, I'll lead you home, chariot. Take you back to where you're from, chariot. One step forward on the road ahead of us. Don't look back, no. You just need a bit of luck. Oh, oh, tonight. Just imagine we woke up in paradise. Don't need magic. Let my thoughts just carry us home, home tonight. Future's golden. Don't let go. Don't give it up. Just keep holding. Even when you've had enough, I will be your light. When you're low, I'll lead you home, chariot. Take you back to where you're from, chariot. One step forward on the road ahead of us. Don't look back, no. You just need a bit of luck. Oh, oh, tonight. When you're low, I'll lead you home, chariot. Take you back to where you're from, chariot. When you're low, I'll lead you home, chariot. Take you back to where you're from, chariot. Yeah, 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 when you're low, I'll lead you home, chariot. Take you back to where you're from, chariot. When you're low, I'll lead you home, chariot. Take you back to where you're from, chariot. Just imagine we woke up in paradise. Don't need magic. Let my thoughts just carry us home, home tonight. Future's golden. Don't let go. Don't give it up. Just keep holding. Even when you've had enough, I will be your light. When you're low, I'll lead you home, chariot. Take you back to where you're from, chariot. One step forward on the road ahead of us. Don't look back, no. You just need a bit of luck. Oh, oh, tonight. When Just imagine we woke up in paradise. Don't need magic. Let my thoughts just carry us home, home tonight.
Once everything's perfectly organized,
I've been climbing up this hill. My heart is heavy and the air is still. All my worries, how long will they last? I don't know how much more I can stand. Will I ever be enough? Will I ever feel loved? So close to giving up. Oh, hey, hey, future me. I hope the things that hold me down will one day set you free. Hey, hey, future me. Don't forget my trouble set you on the path of where you gotta be. Will it be worth all the hurt? All this digging so deep in the dirt. I can't believe that these wounds will heal, and one day there'll be a scar that I can't feel. Will I ever be enough? Will I ever feel love? So close to giving up. Oh. Hey, hey, future me. I hope the things that hold me down will one day set you free. Hey, hey, future me. Don't forget my trouble set you on the path of where you gotta be. Ooh, yeah. Will I ever be enough? No. Will I ever feel love? Oh. Hey, hey, future me. I hope the things that hold me down will one day set you free. Hey, hey, future me. I hope the things that choke me up will one day let you breathe. And hey, hey, future me. I hope the things that hold me down will one day set you free. Hey, hey, future me. Don't forget my trouble set you on the path of where you gotta be. Where you gotta be. Ooh, yeah. Where you gotta be. Where you gotta be. Ooh. start to believe it. Get broken hard enough, it's so hard to heal it. You told me I was wrong and I started to feel it. Ooh, and I feel like I've forgotten who I am. Now I'm rolling back the dark again, starting to see me in a new light. Watch all the shadows fall behind me till I'm out of sight. And I keep on walking till I'm someone you won't recognize, starting to see me in a new light. No pain, no gain, you heard and think that it's worth it. Stuck in that bubble and you don't want to burst it. And your head thinks you found love, but your heart still searching. Ooh, and I feel like I've forgotten who I am. The me before you and I began, starting to see me in a new light. Watch all the shadows fall behind me till I'm out of sight. I keep on walking till I'm someone you won't recognize, starting to see me in a new light. Ooh, hey,
Hello? Hello? If we can take our seats so that we can proceed to the next session. Thank you very much and welcome back. I trust you enjoyed your tea, your coffee. We will now proceed to the next session, that's session 4. And the topic for session 4 is providing pensions for informal employment in developing countries, challenges and opportunities for policymakers. I will now invite to the podium the moderator for this particular session, Mr. Andre Labo, IOP's Chief Policy Advisor. I also invite the panelists, Mr. Mosh Muslalin, Executive Director for Pension Fund Supervision, Financial Services Authority, Indonesia. I also invite Mr. Will Price, Chief Executive Officer, D3P Global, and Senior Advisor on Insurance and Pensions, United Nations Capital Development Fund. Also coming to join the panel is Dr. Elio Sanchez, Deputy Superintendent of Private Pension Funds Administrators, Peru, and Vice President of International Association of the Latin American Pension Fund Supervisors. Gentlemen, you can proceed to the podium. Let's give them a hand as they're coming through. I'll now hand over to the moderator, Ms. Labo.
Thank you.
Good morning, or as I would say in my country, bonjour tout le monde. J'espère que vous allez bien. So this session is, as was said by our Master of Ceremony, is about providing pension for informal employment in developing countries, challenge and opportunities for policymakers. This is an extremely serious issue, and you know that. You all know that. And the minister yesterday shared very alarming figures. First, he did quote a UN study which revealed that 91% of the workers in sub-Saharan Africa do not save for old age. 91. And the main reason were identified as low earning, high informality, and also high financial illiteracy. Another study said that the informal sector in Africa is over 86% of employed population. But this is not only in Africa that we have this situation. This is really a worldwide issue. And this is serious, as I said, because this is an issue of subsistence. If you don't have a pension, you are at risk, in fact, not to have the resources to stay alive. That's just like that. Of course, you could potentially count on the children, but children are moving to cities, and this is not really the solution. So several initiatives have been undertaken. First, to try to apply the formal scheme to the informal sector, but it's not working. All the studies show that we have a big problem when you try to do it. Another way is to set up a universal pension scheme, but that's very expensive, and all the countries cannot necessarily do it. Another way is to develop dedicated scheme for informal sector. Here we have a lot of example, and we have a lot of example in Africa, and I count on the representative, at least of these countries, maybe to intervene, to explain a little bit how it's working. So Kenya, for instance, Ghana, Rwanda, Uganda, Benin, so they all had a special program. But at the end of the day, we have a big problem because we really have a lot of people in the informal sector which do not have the resources to save, or also they're not aware of the need to save, or just they don't wish to do it. So we need a quite important communication strategy first. We need to build financial education program. This is essential. And when developing scheme, it's important to also to have a scheme adapted to the informal sector. For instance, to allow for irregular contributions, to use as much as possible the technology, the mobile money, for instance, to have also adequate payout, to promote annuities, not necessarily lump sum, to have a simple design, to have index scheme, and so on and so forth. So all this mean that this is complex, but this is important. And today, let's try to identify solutions. And I think that this is the best place to do it because you all have a lot of experience in this field. And by the way, let me raise, before giving the floor to the panelists, a question for you. Those IOPS members from a country which has a universal pension scheme, please raise your hand. Wow. So 5, 6. Those from countries which have a dedicated pension scheme for informal sector, raise your hand. Not a lot, huh? So I really wish to know what the others are doing then. And so a first question is about migrant, those who has a special pension scheme for migrant. Raise your hand. Okay, so my dear panelists, you have a lot of work now to convince and explain the situation and provide some solution to our colleagues. So we'll start with Elliot, please.
Good morning, ladies and gentlemen, authorities and officials from Zimbabwe in different jurisdictions. I have to say thank you first for this opportunity to share with you some ideas and challenges as well about social security protection for self-employed and informal workers of Latin America, but focus in Peru, in the particular case of Peru. So let me begin with, and I will introduce some features about the Peruvian pension system. In Peru, we have non-contributory zero pillar focused in citizens older than 65 years old, is means tested, and is focused in extreme poverty situation. It began 10 years ago in Peru. Then we have a contributory pillar, pillar 1 and pillar 2. The pillar 1 is a DB pension scheme, and the pillar 2 is a defined contribution pension scheme administered by specialized pension managers, and the DB system is just is administered by the government. But the interesting situation here is that both systems must compete to enroll new workers. No? That's not common, but they compete. So a worker must be enrolled or in the DB system or in the DC pension system. Besides, it's not in this slide, but we have a voluntary pillar administered just for the same pension manager companies that are private. They are specialized. The banks are not allowed to offer pension products, for example. And then we have some other features. We have multi-funds. We're trying to move to the target date funds. And then about the benefits, Peru offers similar like other jurisdictions, annuities, program withdrawals, but since 2016, the Peruvian government approved the possibility to have a lump sum benefit, which is the most popular. 95% of the new workers who want to retire take this possibility. Okay, this is a map. Let me move to our labor market. In Peru, this is the situation for labor market. We have almost 30% of the labor force enrolled to a pension system, but contributing on a regular basis. I mean, they are employed, they are in the formal sector. The other 70% are self-employed and informal workers. As Ambrosio mentioned yesterday, there is a tiny difference between being a self-employed worker or informal worker. The other feature in with this situation is that there is a group of workers that are moving on a permanent basis from the formal to informal or different category, employed to semi-employed. And there also is a large group of the population, the labor force, that have low income level. They are in a low income level. What does it mean? It's lower than the minimum salary legally approved in Peru. Yesterday we heard something important, and the issue here is that since the pension regulator and supervisor, we decided to know more about our workers, okay? So in that sense, why? Because we have different hypotheses about why they are not saving or not. So from the pension regulator, we commissioned a prestigious company to carry out a nationwide survey to a sample of the labor force of Peru. The first question was, do you consider important to save for retirement? 98% answered yes, it is important. But when we asked, are you doing something? The 62% answered no. They are not taking any action to save for retirement. So it's very similar like the percentage of the informal sector. You remember? What happened with this 31%? They are saving because they are employed, so they are forced to save. They are not doing. There is not a significant percentage of workers that are voluntarily contributing to the pension system for retirement. Who are not saving? Young workers and low-income workers. This is the profile. The reason, which is the main obstacle for saving, the lack of resources and the low access to the labor market. So first thing, I don't have money to save. I have a low-income worker. I am unemployed, so I am self-employed worker, so I am not forced to save. Then some procrastination. I have many years. I have no possibility, no attractive options, financial literacy, and I would like to enjoy my money today. So those were the most important answers. It depends. It's similar with all the cohorts, for example. And then we asked, what do you think will be your source of income at all age? And the answer was shocking. Most of the first answer was Pensión 65. Pensión 65 is a zero pillar, but for extreme poverty situation. That was shocking for me is to have a little percentage of young workers that expect to receive a non-contributory pension. It is a little percentage, but it's shocking because it's not a very good perspective. Then family transfers. The most important, number one, zero pillar, non-contributory, then family resources, and then workers expect to continue in the labor force after 65 years old. Third. The fourth, to receive a pension from a contributory scheme, pension scheme, but they are not saving. So they are postponing the action to save, okay? And then other social programs. This is the alternative. You see in the last, to receive a pension, for example, the young workers expect to receive a pension, but they are doing nothing to save. So it's a challenge to improve coverage. So at this stage, I must say that building a pension requires a significant effort, and a worker must save for at least 30 years to receive a contributory pension. Furthermore, life expectancies increase, and workers will also have to make more than effort to save. So to deal with this challenge, we require solutions. First, this is a chart that I took from the Inter-American Development Bank publication. In here, I will try to show some barriers based on the demand side. Demand side limit capacity for saving, some behavioral biases, lack of liquidity, another barrier, and the lack of financial and pension literacy. Just to put in very simple words, workers don't save for retirement because they don't have money, they don't know how, and they don't want. Three reasons. From the supply side, there are a lack of incentives for encouraging low-income and self-employed workers to save. They are just interested in employed workers, just that. Administration fees are also an issue, and the lack of adequate mechanisms to do or to make voluntary savings. It's very difficult for a self-employed worker to make pension contribution. Let me explain. In Peru, we have a centralized platforms to contribute, but it's difficult. This is elaborated just for employers. So it's very difficult to make some, to use these platforms to make some contributions to the pension account. And besides, managers have scarce knowledge about the informal workers. You must be close to the informal workers. We must know. For example, that was the reason because the pension regulator commissioned this nationwide survey, because we wanted to know more about the informal sector, the self-employed workers. How can we design some mechanisms or make some actions or interventions if we don't know our client? Our client is the worker, the citizen. So we must do some action for that. Second, let me move to this. This is a part of a publication from IDB, okay? But the interesting thing here is that Mexico, Colombia, Peru, and Chile, they make some initiatives with IDB. Why trying to tackle with the behavioral biases? So this is an international experience. So let me move quickly to the results. For example, to push some message, some default enrollments and contributions, some other alternatives that was elaborated for these groups of self-employed workers. Just to, I have a time restriction. So let me show the effects of retirement savings. The first, messages and reminders are not conclusive. They are not conclusive. For example, in some jurisdictions, for example, in Mexico, it have no results. The SMS messages by phone, no effect, but it does have a very, very interesting result in Colombia, for example. But not conclusive because they use a Facebook. But Facebook has a very good result for workers, at least in Peru, older than 40 years old. For young people, TikTok and another social network facilities. Active decision with automatic debts, some good results, and to simplify the access or to give more financial education. So to deal with this challenge requires new solutions. And the opportunity is that there are new allies. First, technology. Technology makes saving easier and more accessible for workers. And then behavioral economics illustrates how to help people to overcome with those barriers. So we have some lessons. Solutions, for example, linked to a source of income have a positive impact on generating voluntary savings. Then reminders. Reminders are easy to implement and cost-effective, but with a little impact on saving for retirement. That requires new strategy. From my particular point of view, that we need is to implement reminders depending on the target population. For example, at the superintendency, a pension regulator, we made a multivariate analysis just to profile, to have clusters of workers and to send specific messages according to the specific situation. So we are trying to implement that. Then it is important to make it easy to save, simple and automatic as possible. Behavioral and technological tools are necessary, but not enough. We need to make easy, and we have another barrier that I took for this, for the last. Our regulation is very strict, complex, bureaucratic. So we implemented a regulatory sandbox just to offer the opportunity to have some flexible products for saving. The interesting here is that as the superintendency is responsible not only for pension, for the pension sector, but also for banking activities and insurance. So we implemented this regulatory sandbox. The interesting thing here is that the first innovative product offered that we are analyzing at this moment came from a pension entity, not for bank. So we're analyzing. Besides, we have also a pension manager that makes a commercial alliance with with gas stations and other stores, for retail stores, for example. Our objective with this is to simplify the model for a very short time, maybe 3 years, giving the opportunity to be flexible, to offer an innovative product. That's why we are trying to implement here. I have no time, so this is some criteria that the pension manager must complain to have this authorization. As I told you, at this moment we are analyzing a new idea. So we're trying to make a checklist with these criteria and to provide some benefit, to be flexible, of course, again, to be flexible with this. This regulatory sandbox, of course, has the opportunity for group application, not only one, maybe for an association. We have 4 pension managers in Peru, and also the possibility to coordinate with other local or international sandboxes. That's possible. So we try to be very, very flexible with this. Just to finish, some final remarks. Self-employed informal workers requires a continuous study and profiling. Self-employed workers is a group that is not homogeneous group. You must analyze. For example, in Peru, despite agricultural sector, the second most common activity is a commercial activity. Then the informal sector are taxi drivers, truck drivers, for example, and other activities. So in this group is different. They think different. It's impossible to ask a low worker, a low-income worker, to save $30 per month, as a formal worker must pay. But it's different if you take $1 per day. It's different because they receive the income on a daily basis, maybe on a weekly basis. So it's different. You have to tackle with these obstacles. So we have to be flexible with the regulation. We're analyzing, as told you, we have one that have been implemented. We're in a second. And you must remember the reason for not saving. Lack of income, very low income workers, that you must have micro contributions. You must prepare for your platform for this. And you have to tackle also with some behavioral biases: procrastination, optimism, risk aversion, passive choice. So the possibility, for example, to have a default option to save, saving for consumption, or when you pay your bill, for example, electricity or water provision, you can put one sol, for example, or a percentage of this bill just to save for retirement. That requires a very elaborated ecosystem just to save. And that's all. I have no time, so thank you very much for your kind attention. Thank you.
Mr. Minister, Excellencies, and ladies and gentlemen, good day. It is an honor to me to stand here to discuss a very important issue, as Andre really mentioned in the beginning, that this is also the one that we pass or we challenge us the couple of years. And my presentation today will bring Indonesia as the country case. So we move from this in a big, great Africa, and already we move to America, and we go to Asia. But before my name is Mukhlas, and I represent the Indonesia Financial Service Authority. But before I begin my presentation, I do apologize that I put some rather beautiful image of Bali, the island of gods. That will be, this is a teaser, what we will, you will see and experience in the next IOPS or OECD Global Pension Forum. Hopefully it will not distract your attention so much, so we can just, what the issue we talk. So, as many emerging countries, perhaps that Indonesia economic growth bring a lot of opportunities, and some opportunities come from informal sectors. We have a unicorn startup like Gojek, Grab. This is a $1 billion industry, and also we have a really vast, famous e-commerce like Tokopedia and Shopee. And the new business model allowing individuals or small groups or even family to start their own business and not enroll in any company at all. So from the data, we see since 2017 that the among the labor forces, more than 50%, so 67% is in informal sectors. It grow up into 60s. So the growth of informal sector in Indonesia is much higher than the formal sectors. And I think we can expect another increases in a year to come. So with the labor force of around 150 million, so around 85% or 55 millions plays a role in a informal sector, and it's, the contribution to the country's GDP is tremendous. And thus we, as a regulator, think that it is our responsibility also to ensure that this for informal sectors has some kind of protection. So let me begin also with pension, perhaps as Eli also, we have the mandatory pension. So this is a universal pension starting in 2004 with the Amendment of Social Security Act, and just operated in 2011, so lastly then around 12 years. And we also have the voluntary pension. It's much longer, I mean in 1992. So a bit different with other countries. We start from voluntary, but we start the mandatory a bit late. So if we look at the coverage of both mandatory and pension, mandatory pension program and the voluntary pension program, again, don't look at the picture, just at the numbers. From formal workers in the mandatory pension program is only around 17 million. Yes, it is much, much lower than what the labor force are. And the informal workers is around 500,000. So, but bear to mind, this is only around 12 years. And the voluntary pension programs, 2.5 million, 900 of them, 900,000 is in informal sectors. So question that arises is whether these informal employees, we are not covered in a pension system, whether it's mandatory or voluntary, do they really have some sort of old age savings, or they don't just think that it is not really in their concern? So we look at the several type of investment in Indonesia, and we found out that capital market activities so far, this is also when we have a FSAP mission early this or middle of this year, we have a discussion with World Bank and so on. It's by a bit surprising that most of our active investor in capital market, from around 11 million, 99% is individuals. So we'll see that around 11.38 million individuals are actively invest in capital markets, while corporate, including pension fund, is only 0.2%. So we have to look at what the other studies saying of what is the informal sectors in Indonesia. From the gender, we look at mostly female, more than 63%. And if we look at the education, the biggest part is informal education, which is no special certification, no formal school, and also dropouts. So they don't really finish their primary school. So then after we learn from this, and also we know that Indonesia is a very, very young population. We have around 65% is in a 69% population, or around 190 is in a young population in a population country. These millennials and also Gen Z is so important, both in economy and social. So what we do this is that first, most of them are skilled labor, and some of them are women. We know that 99% of capital market active investor is millennials and Generation Z, and they are skilled workers. For me, the data is screaming that we are youth. And sometimes, one of our studies find out that young people, youth, is in other extreme compared to old age saving or pension in other. So that's why they want to go to the capital market rather than join the public offer fund that we have. Then why? I think we are in the policymaker already do anything. We are discussing about how to increase financial literacy. For you who attend the technical committee meeting yesterday, our chairman, our chief executive already mentioned about financial literacy, and we're also talking about expanding the socialization and so on. We try also to enforce the voluntary pension for the company. However, we talk, we enforce, yet we are not really listens to those are millennials and the informal sector. So back to the slides, we learned that they are digital nomad. They are really, they are internet natives. They grow with as perhaps Dominic really mentioned before this session, that they are really fast to learn to and embrace the digitalization. And so they are job hopping. They change company often, they change job often. And then based on the study, the common pension structure, which we have right now in the occupational pension scheme and existing pension regulatory scheme, is put in test. Is it really, are we, that's the question to us in the OJK, are we actually developing a pension scheme that are suitable for the young generation as they are today? So let's go to the opportunities. We know that through some studies that we have to expand through digital marketing. So we have to put in force, mean we, it's not only the regulator, but also the industry association and so on, to try to tap into the digital marketing. And as Indonesian is very keen to use the e-commerce thing, why we don't collaborate with the e-commerce platform? So probably we learn from our colleague here, Elio, that Peru already have sandbox and so on. We are in a really beginning stages. We just launched the financial institution omnibus law early this year, just February, and some of them are really have a good environment for a more, let's say, community or more demographic friendly. And we hope that by using the digital and adapting into the digital platform they already in place, we have to simplify the procedure, for example, in participant registration and other administrative process, and increases flexibility, creating tailor-made scheme, which is not possible by current regulation, and creating ease of access and bundling scheme with other familiar financial services product. And the other is for us as a policy makers, we have to know that one of them is policy or tax incentive. Is there any tax incentive right now? Yes, but it is still very limited. And as we discussed earlier in this conference also, I think that yesterday, that a question of equality, whether the incentive is effective or just wasting taxpayer money is also right now is debated in Indonesia. So that's, ladies and gentlemen, that's the end of my presentation. But before I finish, shall we have some a bit knock-knock jokes all together? Yeah, you know, I say knock-knock and you will say who's there or something like that. Shall we? Okay. So, knock-knock. Will. Okay. Will who? Will really love you to meet in Bali next year. Thank you.
It's turned off. Okay, let me check now that at the back that people can hear me, and maybe a little further away. Thank you. Well, so thank you, Commissioner Murudzikwa, Deputy Minister Munungawa, Julia Chilikova, and our President Rinaldi, and old friends Pablo and Brendan Kennedy, Darius Stanko. It's a great pleasure to be here in a sort of new incarnation. So I used to come to these meetings, and now the work that we do is building on experience when I was at the World Bank and in the UK, still with governments around the world, with international organizations, and working from the whole kind of span from setting up a pension system through to the kind of very details of the regulation. But what I want to talk to you today is a kind of new project that we're doing with the UN, the United Nations Capital Development Fund. Before I get there, though, I want to just, as a side note, say thank you to Zimbabwe as well as to the delegates. So 15 years ago, I went to see Iguazu Falls in South America. And then when we lived in the US, I went to Niagara. And then yesterday, I went to see Victoria Falls. So I'm glad I saved the best till last. And it's a great pleasure. As long as no one sees me do a presentation in Brazil, where I'll just kind of flip the order. But so what do we want to do, or what do I want to do with this presentation? So it's a big issue, and it's quite a new issue, and that maybe people haven't focused on. So first of all, thanks to the OECD and IOP for putting it on the agenda. And what I want to do is tell you, or try and convince you, that it's important, that there are things that can be done, and in particular, that there are things that can be done for individual countries sitting in this room. And we'll go through sometimes some quite sort of simple steps. The reason it makes sense to do this in the informal sector section is that lots of the solutions for migrants, people who are working in another country, a host country relative to their home country. Also has some tie-up with the informal sector, and so we'll talk about, you know, innovative ways to get people into a pension system, but the fundamental importance of sort of old-fashioned values, if you like, on administration, keeping an account for life, not losing accounts, good governance, investment, because lots of the solutions to get people in, to make contributions, are from lots of innovation, which is very welcome, but it's very important not to forget the old-fashioned importance of well-governed admin and investment, and pensions is a long-term business, so we need to remember that. So let me do the first one of, can I convince you that this is important? So I probably can convince you, yeah. So let's go from the left-hand side. There are 281 million migrants in the world, and if they were a country, they just beat Indonesia as the 4th largest country. Those 281 million migrants send back to their families, to their home countries, $1 trillion a year, formally and informally, and most of that is to lower and middle income countries. That money supports 800 million family members. So you're talking about 1 billion people affected by this policy who are actually, you know, often low income, but there's a huge amount of money. So there's a great potential. But even more than that global potential for individual countries, it can be even more important. So some countries, take the example of Nepal, the remittances from migrants are 25% of their GDP. In other countries, host countries, migrant workers can make up to 90% of the labor force. And going forward, as you go to the right, you take this 281 million, you take the trillion, and if you're taking small amounts of this money into insurance premiums, you're talking multiple billions per year, and the claims will be hundreds of billions in the next 20 years, and we'll talk a little bit about that. And you're potentially talking about trillions of assets. Now, all of this seems sort of very optimistic and somewhat unachievable, because lots of the things that we've just heard about the informal sector are true of migrants. So how is any of this possible? Number one is that the cost of remittances are so high, the average 6.5% of the value of the money sent goes in fees. Some corridors, it's 10%. There's a UN Sustainable Development Goal target to reduce that to 3%. You can already do it for 0.5% or less if you do it digitally. So in many cases, you're not asking the migrant worker to find any more money. It's a question of repurposing the money they are already sending in the context of digital innovation and better payment platforms. So number one, that is, you don't necessarily need more money. Number two, and let me show you the next slide. This is a survey of around 3,000 migrants. Just look at the top bar. So the top is telling you in the red what you'd imagine. Most of this money, the majority of this money goes to just giving people, family members, money for consumption. But what's happening here is, of course, when those family members are old, the migrant worker is already the pension system for their family, and I'm sure lots of people in the room are partly fulfilling this function. But now look down at the lower red, the red line. A surprising amount of the money, 20%, already goes for savings activities. Now, that's not necessarily just saving in an account. It could be saving into buying land, some property, an extra room that you can rent out. But there's already quite a high degree of saving, but it's often very informal. And one of the biggest challenges here is what happens if something happens to the migrant. So we're talking about this as insurance and pensions. The migrant dies, it's a disaster for their family, because suddenly that pension system disappears. If the migrant dies with life insurance, then the family will get a payout. The pension aspect is partly for the family members, but also for the migrant. Anyone who's been a migrant worker sending money back to the family, it can be very challenging because you're supposedly the rich person with the good job, and your family suddenly grows. There weren't so many at your birthday, but once you get the good job, suddenly you have more aunts and uncles and cousins and people who are asking you for contributions. It's actually quite useful in some studies that are done if the migrant worker is able to say, or indeed, even if it's an internal migrant and it's someone moving to the city from a rural area, if they're able to say, I'm sorry, the money is locked away, I have to give a certain proportion to the pension plan, and I cannot distribute it because that migrant worker at some point will be coming for their own retirement. And this also emphasizes another point and why it's useful to think about this as the informal worker, because people have diverse lives, not just multiple jobs, but the migrant worker from South Asia working on a construction site in the Gulf countries could have been an informal worker. They could have been a formal worker in their home country. They may have a business when they go back. And you've got lots of these different incarnations, lots of these different income streams. And the question is, how can you stitch them together rather than have lots of clever, innovative products in each individual stage of their life, which just leads you to have lots of small accounts, lots of accounts where there's not a very high balance, the rules allow you to withdraw, and you're never able to build up that long-term income. So let me skip through that. So I told you it's important, and hopefully we can, we've established that it's important. So what about that it's practical? So just focusing on the global, the regional, and the country, not so much the individual parts of it. The global, well, firstly, it's these kind of conversations. So great thanks again to the OECD and IPEC for putting it on the agenda. The Toronto Centre is a global think tank in Canada that focuses on regulation and supervision. We're publishing a note on this in the coming days. So it's globally getting attention. The regional is fantastically important. As we heard from the finance minister yesterday, lots of regional innovation or regional engagement, whether it's kind of more continent-wide, like the regional development banks, or more focused like SADC and the various regional elements, because there is a big regional dimension here. And whether it's because mobile money is much more important in Africa than it is in other countries, thinking about what works regionally in terms of the way that people do their live their financial lives, if you like. And then it's also really important from the country level, and I'm going to go into this more detail because it's the practical steps. So we heard yesterday about the example in the US of Uber drivers and the whole kind of question of the gig economy, and that meaning that you're disentangled or you're disintegrated from a social security system, and those drivers won't get a pension. But that's highly specific to the country. So in the UK, there was a landmark legal judgment which identifies Uber as effectively an employer for the purposes of pensions, private pensions. And those workers who are Uber drivers have had the contributions by the company backdated to 2017. And now every time you use that gig worker, the Uber driver in the UK, they are building their pension. Probably not enough, but this is about steps forward. It's building retirement sort of a year at a time rather than guaranteeing 30 with a single policy. And those platforms, as we mentioned, or as we heard from Mochi's presentation, Grab, Gojek, different platforms in different regions, those can all potentially be an important way into this because they are already digital payments, they are already digitally identified, and they already solve lots of the problems which bedevil pension systems in terms of enrollment and finding people. So now let's go through to some country examples. Now, this is a busy slide. I realize now it's the Rugby World Cup, so just focus on the rugby ball in the middle, if people know what the ball looks like. But and focus on just some of the countries. So the top left-hand corner, we're talking about the United Arab Emirates. Now, on the one hand, tough country. If you're a migrant worker, you will never get citizenship. You will never get access to the social security that the citizens of those countries get. Nice sharing between the Gulf countries. So stony ground in some ways. But if you go to the UAE, you will have, in some of the Emirates, compulsory health insurance as a migrant, paid by the employer to mean that you are covered. The gender equality could be improved because domestic workers who are typically women have slightly less coverage than construction workers and other workers who are typically men. But they're actually now migrants having health cover, and it's compulsory. In a part of the UAE, there's a compulsory defined contribution pension plan for migrant workers paid by the employer again. And so there are the seeds, if you like, of things which can work here. If you look in other countries, many of the countries, South Asia, Philippines, have compulsory insurance for their own migrant workers when they go overseas, so you get a base level of life, health, accident insurance. And to take the example of Bangladesh, they recently extended that compulsory insurance to include employment interruption, which on the one hand sounds quite technical, but when Bangladeshi workers were faced with the tragic events which are unfolding in Sudan, they lost their jobs. They arrived back in Bangladesh, but they were the first cohort that got an insurance payout to mean that all of the money they invested and the time to get that job, and migrants often have to spend money to get the job, and they start with that. All that money was then repaid, and they got something for the families. India and Mexico have both done innovative things so that a remittance provider, the worker working overseas, can effectively contribute directly back into their domestic individual pension plan. And in Mexico and India, you have the platform of well-regulated pensions. So let me conclude. I said that there would be some simple steps. Actually, just before that, we started a social enterprise called Pensions Across Borders, which is aiming to connect global donors, foundations, large companies, who would, if a country had a good pension system with individual accounts, that they could transfer money into the private account of a pensioner. Because cash transfers themselves, sometimes they work, sometimes they don't. If you transfer the money into an individual pension plan of a 20-year-old, a 30-year-old, a 40-year-old, if they match that payment, each dollar of transfer has the potential of growing 8 times. And so it can be a very important way that you can leverage all the work that people have done now to have flows, whether it's from domestic employment, migrant workers, or international donors. So let's do a quick run through of what this means for you going back to the day job tomorrow. Number one, so review the flows of men and women. Are you one of these countries where migrant workers are very important? Data is available from the World Bank on flows, from the Institute for Migration on people. Number two, identify the gaps and the risks. Are you a country where you've got good universal provision, in which case maybe the migrant workers need less when they're overseas? Are they going to countries which have compulsory elements? And so what's your specific country corridor focus? Because you don't have to focus on 200 countries. You'll probably have 5 or 10 countries which are disproportionately important for you as a regulator. Number three, what are the improvements in a very practical way so you can stitch together these things in a better way? Bangladesh just launched a mandatory sort of basic pension system, but they have a specific, so I'm holding up my hand for Bangladesh, a specific migrant pillar of that new social security system because it's important for themselves, so they've built this in. Number four, develop the regulatory and supervisory links to the host country that's important to you. Again, not 100, there'll be 5 maybe that are really important. And think about the risks to my migrants when they're going to your country and how we can make sure that you've got a better coverage. Work out those flows of data and then review the products and thinking through what are the barriers. Because of course, when you're home, it's very difficult to pursue a claim if you're not in the country. Final 4 before I wrap up. The next financial inclusion review that you have for your country, these are very popular, often sponsored, often funded, often driven by a central bank or one of the ministries. Engage with it as you do as a regulator, but add into it the migrant aspect, your home and host country, when that's important to you. Focus on those cross-border payment aspects because often pensions, individual contributions don't trigger money laundering rules. But if you come back after 5 years and you want to bring back a more sizable amount of money, maybe they will. So you can use the visa and the ID process as you transfer country to have good ID and have a bank account pre-identified that can receive your money and cut through lots of these rules which otherwise can make it very difficult. Number 3, support efforts to reduce the cost of remittances, maybe not directly you as a pension or insurance regulator, more as a central bank, but that unlocks the money so you're not asking for people just to find a little extra where they don't have the money. And number 4, exactly what you're doing now, work at the regional, the international bodies to raise the issue and think through solutions and try and help the migrant insurance and pensions help round out the informal sector coverage that we've been speaking about. Thank you very much.
To 3 panelists. Now I will open the floor for questions. I remind you, please do speak close to the micro. We have a problem here to hear at stage. And also, personally, I'm getting older and older, and my hearing is worse and worse. So I would appreciate. Please don't be shy, because I can also ask questions to you. Be careful. By the way, I have a short question to Will. You say that we have 281 million of migrants. I was surprised by how precise it is. But are you including illegal migrants?
So it's all so that's all migrant workers. So some obviously that's all migrant workers. But obviously the precision where there's no kind of official trace is not there. So the number is almost certainly higher if you add people who've gone cross-border, and particularly where there's long-standing agreements, say, between Nepal and India, where you're allowed to go in and out without visas, and people may be working across borders. But I think the main thing is it's a very substantial number. There's a lot of money, and for particular countries, as you go through your risk-based supervision, thinking, what are the key risks for me in my country of the people who have gaps in coverage or are contributors, and how do I reduce the risks of old age poverty? It's just going through the numbers that you have for your country and working out whether it's important for you. And the answer will be no for some and will be yes for others.
Thank you. Yes, please, micro. In the meantime, a question for Mok. You provided figures, also numbers for mandatory scheme and mandatory pension program and voluntary. But if I'm adding all the number, this is about, let's say, 25. But you have 138 million employed in Indonesia. So where are they, all these 100 millions? I would be.
That's very interesting because the body or the agency that are responsible for the security, social security, is right now just tapping into the civil servants and then the army, which is around, both of them is around 6 to 8 million, and also the companies that already have some kind of formal pension. So they are not really goes extensively into other type of employment. So yeah, there are some small companies, they are not really registered yet, and that's a lot of Indonesia. Thank you.
Thank you. Please.
Yes. My name is Farouk Aminu from Nigeria. Just
close to the micro, because you need
yes.
to.
Okay. It's a contribution and perhaps a question. And I think in trying to get macro pension, informal sector people on pension schemes, there may be the need for us to classify them perhaps into minimum 3 groups. You need to classify into high-end earners, middle income, and the low income. And indeed, it's important because then you target them with different products that will attract them. For the very low-level income, I think we need more than just providing pension schemes, but perhaps the a participation of the entire financial sector, because for them, there may be the need for us to look at the financial health of this group. Mm-hmm. Can they even save? So perhaps what we need is to maybe boost their income in the first place so that they can handle some basic needs at home before they're able to save. So perhaps if we want to help these people, I think perhaps we need to consider it at a very high level. So that's one issue. And on the migrant workers, rather, I think in West Africa generally, we signed, our presidents actually signed an agreement for repatriation of their pension, assets back to their countries when they retire. And based on this, the National Pension Commission also issued a special guideline to this effect. So if you work in Nigeria, we don't have a special pension scheme for the migrant workers where you participate in the general scheme, but when you retire and you're moving home, then the guideline has allowed you to repatriate all your pension assets back to your home country. Thank you.
Thank you. Do you wish to react? Panelist? Emilio?
Yes. Thank you for the comment. I must say that there is an opportunity, for example, when you mentioned about the participation of other industry, maybe bank. We have an interesting opportunity. Why? Because in Peru it became very popular an electronic wallet. For example, it began one financial institution launched this possibility 6 years ago. It's supposed to be 100,000. They now have 9 million users. When I go I take a taxi, I pay the taxi driver with this electronic wallet. They use every day with very small amounts for transactions. For example, I went to the informal sector just to buy vegetables, for example. And everybody use the electronic wallet. So this is a very interesting opportunity. I cannot say more, maybe because we are analyzing and trying to convince some entities just to participate with this regulatory sandbox, but this is a very interesting opportunity. Besides, a group of these informal self-employed workers see in this defined contribution scheme a very interesting opportunity. Because, unfortunately, because the Peruvian government decided to have an extraordinary access to the pension pot. So, for example, we have 20,000 workers enrolled to the DC pension system per month. They used to enroll 5 years ago. Nowadays, we doubled this number. 50,000 of new entrants to the DC pension system. This is an opportunity, but enrollment is easy. The difficult thing here is to contribute. That's a challenge.
On the contribution for low-income workers, it is interesting based on our discussion with several ministries and also with the labor unions. Because in Indonesia right now, the focus of labor union is still on the day-to-day or current minimum wage and something like that. And when we push the agenda of pension, they think that they are not their priority right now. That's very sad to see that. But in an economy where you have lots of labor in manufacturing and other construction and so on, while the labor union is not really think of the horizon of old age, something like that. And we, in a policymaker, try to push this agenda, but I think we need several times to do it. And we successfully put an article in the new financial services omnibus law that will have some additional on top of Pillar 1 right now is a mandatory, but will be a choice to choose the operators. This is a DC plan, but it's still, this is in the law. Based on our experience, it needs another 3 or 4 years to put it into implementation. And hopefully, they will cover all low-income contributory system. Thank you.
One thing on the people on the very lowest income is all of what I was saying. In an ideal world, that comes in conjunction with a basic poverty alleviating payment. You see it in lots of countries at a very low level, and it's, you know, this is a kind of a twin track approach. But of course, if you have nothing, then you have to take the decision of where you would go. It's also worth mentioning the family, that even if family structures are not the way that they used to be, even if the family can solve 10% of the problem of multi-generational households and sharing within families, I would urge people not to forget it in the way that maybe some Western countries have. But if you're here or in East Asia, South Asia, it's still an important part of the picture. One other thing in terms of the lower income people is just also the incentives. So tax incentives, as we heard yesterday, don't make any sense if you don't pay tax. And so countries experiment with flat rate contributions. The Bangladesh scheme I mentioned, there's a specific one for low income people where half of the contributions are paid by the government, but the other ones for the other higher income people are not. So you can target it. Same, India has experimented with individual programs for the very low income. So kind of having different ways into the system, but having some kind of core administration and investment which allows you to make sure that you don't lose the pension pot. Because it's great what you were mentioning about Nigeria and the ability to transfer the pension at retirement in West Africa. One of the issues, though, with migrant workers is often you're there for a year and you stay for 50, or you're there for a year and you leave after a year, or anything in between. And so it's quite a diverse, highly mobile population, and lots of countries find it incredibly difficult to find people even within their own country when they have multiple plans. Finding them cross-border can be very tough. So the migrant pension aspect of the policy may need you to be able to transfer earlier, but ideally transferring from one pension that you've been getting in the host country back to a pension pot that you already have in the home country, so you're kind of amalgamating, stitching together all of these things rather than kind of dissipating the impact.
Thank you. Yes, please. The micro is coming. Pablo, be ready to respond to the following question. What are the views of the OECD about how to integrate pension for informal sector? Yes, please.
Yes, thank you. My question is directed to Mosh from Indonesia with regard to the fact that the informal sector workers will not save on their own. I bring this up because Uganda has just concluded a study similar to yours, and one of the challenges we face is that if you have low tax capacity and you are proposing tax finance incentives, how are you making the policy case in Indonesia? Thank you.
Yeah, please.
Thank you for your questions. I have to have a disclaimer that this is thinking in us, a regulator, because tax department may not be agree with us. So, but our thinking is because right now we have a EET, the model. However, we in Indonesia tax ratio is so low, as low as well. Probably the average is less than 20%. So the incentive is not that, what we call it, not interest for them. So what we're thinking is that we try to put more incentive on the investment, and also there will be such like an automatic enrollment, and rather than they have to give a separate registration between the goes to in pension body or pension funds, and have a separate or dedicated, which is the tax return yearly. We try to make it, if they agree to have one system, that every time you goes to the pension, will goes to also the report will goes to the tax office. In other developing countries, perhaps this is already there, but for Indonesia, with the vast areas and so on, this still a problems. And we know that this kind of incentive, along with others, so the administrative fees and something like that, the costs, I mean, it will be give them a seamless and easy to enroll in a pension with, they will, what we call it, they will really feel the benefit, rather than right now there are some what they call it, the administrative burden if you are also enrolling in a pension and you have to claim your benefit or your tax deduction from the tax office. I think that's most of one. And then the other is by giving more intensive incentive, because right now it's not all of investment portfolio exempted. So mostly in the light capital gain is not tax incentive there. It's only on the interest or banking and so on. And it's also from the property, there are no incentive there. So we try to talk with the tax department on how to expand the or flexibility in a tax regime. I think that's what we feel right now. Thank you.
Thank you very much. Yes, please.
Hello, I'm Eric Cheng from the Mandatory Provident Fund Schemes Authority, Hong Kong, China. I have a question about the policy recommendation or policy preference for extending pension coverage to platform workers, which is an emerging sector of the informal worker with the advance of the gig economy. And so Will just mentioned the landmark case of Uber in UK, and so it effectively created a new class of worker relationship beyond the traditional dichotomy of employee and self-employed persons. And but that is in a way a limitation, because it's just one type of labor benefit, so it may stop there. So some labor unions in our jurisdictions are trying to push for a formal recognition or direct imposition of this employer-employee relationship on platform workers. And so I would like to seek the panel's advice. Which way would be the way to go, in particular in the developing country context? Thank you.
Okay. So, who's starting?
I mean, it's a really good question, because you often go to a country, whether it's developed or developing, and you see the full list of social security benefits in the formal sector, and it can be pretty large. And it's not to say that any of those individually are wrong, and there's lots of good ILO conventions about what should be delivered. But if you're ending up with contributions which are effectively 30, 40, 50% even of the wage, I think it's very difficult to transfer that model to the relatively low-income side. And so I think the question would be, start somewhere, and the thing that you're guaranteed is that those low-income workers will have no pension. Now, for me, obviously, maybe for this audience, the pension one seems to be the most pressing. For the individual, it's probably life insurance, which you can add quite cheaply. So not necessarily the full contributions for life and health, but adding a small amount of insurance, at least you can start having some of those benefits. And thinking through the migration and the remittance side, some of the remittance providers offer kind of freemium products. So if you send your remittance with us, you actually get free life insurance, because it's a kind of business advantage. So there are ways of doing it quite cheaply. So I would sort of go through, but in an ideal world, you'd be able to have the full list, but I think for the country context, you would take a more limited one. But as I say, the one you're guaranteed that will have least is, I think, the pension side of things. And what you're doing, I mean, pensions, from the discussion that people had about access to pension funds, I think I'd say two things. One is, of course, housing is expensive and people want housing, but you're finding a kind of a pension solution to a housing problem. And it's just because there's money in the pension. Well, you could use the money in the pension for health or education or roads or anything. So don't use a pension solution for your housing problem. And the second one is pensions, in a not in a sort of joking way, is a form of time travel. And you're trading the meal you're going to have when you're in total poverty age 70 with the money you need when you're a 40-year-old, and you've got lots of these different things. And the one guarantee is, if you spend that money now, you are definitely not going to have it when you're 70. And no one is doubting that people have a lot of problems now. But what we know, unfortunately, is that you will guarantee that your problems are going to be worse if you're a destitute 70-year-old than if you at least have the chance to earn a little more. So those, just to make those 2 points.
Thank you, Mark.
Yes. It is interesting that, thank you, Eric, you already mentioned about Uber. Uber is not longer active in Indonesia since, I think, 5 years ago, but we have the same platform like Gojek and Grab. And it's around 3 to 4 million drivers of this kind of, and Gojek is, or Grab is more move not only for a hail ride, but also for one single stop for a Go Food, Go Massage even, Go Clean, and that kind of Go Beauty, if you want to have a homemade home services, beautiful. But we look at this model, this platform. Of course, for the platform, probably yesterday we talk about your platform, MPF, and we are a single platform for every provider is very good, and we try to move it. Because right now, Gojek is a very fertile land or fertile business for microinsurance, especially travel insurance and also insurance for goods and services that they send. So we try to have a understanding and try to understand the models and really push the insurance in the pension industry, mostly the public offer fund, which is in our term is financial institution offered by banks and insurance to tap up this lucrative market. Hopefully, we will have a fruitful discussion with Gojek on how to put pension as part of them, either for the drivers, but also for general population. Thanks.
Thank you. Yeah.
Then, well, besides, I mean, I would refer to the pension coverage again. It's not easy. It's not there is no unique solution. So the thing for us is to offer to the workers, because they are moving from employed to self-employed, a lot of alternatives, all the alternatives that you can implement, from micro contributions to the formal contribution, because they are moving. Our main concern is the group of low income, with low income levels. So you must offer them different alternatives and consider that maybe they will be at the formal sector in some time, in some moment, at different times. So another issue is to know the customer. How can you offer them something, a product, a voluntary saving alternative, if you don't know this group? You must be close to this group to profile, to analyze. And that is an issue, because pension regulators are not, the profile is to be, we have lawyers, economists, engineers, but we must be close to the worker to offer and design a regulatory environment just to promote the voluntary saving for retirement.
Yes, please.
Actuaries. My question is directed to both Elio and Mark. Here in Zimbabwe, we recently have passed regulation that then makes the required regulation for the establishment of micro pension funds. My question to you gentlemen is, in a world where there is so much pressure for instant gratification, and also in a world where some industries are looking outside of their traditional spaces to look for solutions to address some of their problems. I'll give you, for example, in the medical scheme space, where we have seen them introducing, for instance, your skill membership being linked to your gym membership, for instance, and then that you'd get discounts for your skill membership depending on your attendance to the gym. And also, we have seen them introducing things like membership to loyalty rewards and lifestyle rewards. From the experiences that you have had so far, are there any ideas around that you probably would consider would be an attraction to especially the younger generation for joining the micro pension funds. Thank you.
Who starts?
Thank you for the question. In 2015, 2018, I'm involved in the micro insurance program in here in OJK, in my home country in OJK. And what I found out is that for the, we try at that time also try to think of how if we expand it to micro pension. And we found out in a micro insurance scheme that if we want to reach a vast majority, which in Indonesia is digital is the key. And by doing digital, it's not, it shouldn't be solely for one insurance company, for example. It should be a multi-provider platform, or we can have aggregator or something like that, some startup. However, this will ask or the answer the question of in our case the youth population who want to tap into digital and they want to have a power in their hand, which is the handphone. So, for example, for the capital market, how they can reach from just around 2 million into 11 or almost 12 million because they have a micro investment. As cheap as 100,000 rupiahs is around $8, you can invest in a mutual fund. And it is in a platform, goes by runs by the stock exchange. So when we talk about this kind of the key success factor for this type of cooperations between the insurance provider and mutual provider with the platform is that it's not. It has to create additional benefit or additional value, both for the company, the platform, and also for the target market. But also, it should be a part of the business process itself. Should be in not as an addition that make them has to create another application and so on. So that's the way it began with the micro investment and also the micro insurance. But pension, it's a bit different because our pension is a bit strict. It has to be an annuity. There is no or very small lump sum, and it has to be a periodical or investment contribution. So it is very occupational type, even for the public offer fund. So that's what we try to push the agenda in the law and try after that to go to the. So it has to be a holistic one, but we, from the regulatory perspective, should put into account the interests of the players and also the interest of the target market, which is the population. Thanks.
Thank you for your comment. I agree. We need a holistic point of view. We need, behavioral and technological tools are very important. We must use that. But those tools are not enough. You have to combine with this with some specific products. You have to make or to implement a different kind of solutions for these micro contributions. In Peru, as I said before, we have an opportunity because there is a possibility to access to the pension pot. It's not easy, but this is an opportunity. We would like to change the law, just giving the opportunity to access to the pension pot just for emergency or any specific situation. But the liquidity is an issue, as an interesting issue for this group. It's not the solution, I guess, but you have to capture this attraction for these workers and we want to make them to contribute for saving. Just how to combine the short term with the long term. Maybe liquidity, maybe an access to a health system because they are not protected, for example, in Peru. So maybe a link with this. And to find some commitment device, maybe to link to for example, for taxi drivers, they have to pay a specific device just to save to save the gas or the gasoline. So they must pay. And if you put a percentage when they put the gasoline at the car, you can make them to contribute. For example, we're trying to make this experiment with some taxi drivers in Peru. Thank you.
Thank you. By the way, as we started late, we are allowed some further minutes, not too many, but still. Yes, please, there. I will especially ask you to speak close to the micro because you are very far.
All right. Thank you so much, Andre. I've been Mvula Elia from Zambia, Pensions and Insurance Authority. I've enjoyed the different delivery channels, especially with regard to contributions such as gas stations, pharmacies, and the like. I've also enjoyed the Indonesian capital market, which is saturated by individuals, participants, retail, which is a very good thing. And I'm thinking that you must be doing a lot of financial education in that aspect, and it is really rewarding. And I was also impressed to see that the Peruvian study, which you did, had 71% of the participants recognizing the importance of retirement, and yet very few people are actually saving. Now, the biggest challenge, I think almost all of us who are here are already doing something in terms of extending coverage to the informal economy, which is very important. But then, how do we balance up the benefits at the end of the day? Are we sure that the benefits will be adequate enough to alleviate poverty and avoid destitution at the end of the day? Aren't we going to be beaten up by these informal workers once they retire and they find that the money they are getting or annuity they are getting is actually even smaller than the social cash transfer where they are not even making any contributions? How do we balance up that? Thank you.
So if you can respond before that, are the member from Rwanda here? If yes, I would be very interested to know on the main challenge that you met with the HESA long-term savings scheme. So, but first, our panelists.
Okay. That's a very difficult question actually for regulators because to predict what behavioral of our target or our population is a bit hard, especially for a low-income population when we have to deal with other more pressing issues for them. So, for example, when we talk in there are some problems with the economy, then they will be put more stress for them compared to the middle income and high income. So to answer your questions on how to rate, we have do we have the cash transfers, and it's a bit lot I think recently. We put it into more digitalized. So that's why this is also one of our means to put more literacy on the digital. However, when we try to push them to spend some of their daily income into pension, which is 25 or 30 years later, it's a bit hard. We do have some heroes. We know that in in a central Java, for example, I've met one of regional banks, pension funds offering for the public, who has a very champion. There is a guy or a bunch of informal workers there. This is the cleaners. They spend almost 30 to 40 their monthly wages into pension, but it's very rare. And it is very, very unfortunate that most of the people will see how to struggle with their breath today rather than thinking about what they will say for the future. So yes, again, I think what we learn from this conference, also from LEO, and to make it as a case or something like that, probably will be put more effort in that. We already thinking about using the electricity, or also because some of us are very keen to our cell phone, so we probably put in the poolside and so on. So, but it's still in a table, and hopefully we can see the result in next years to come. Thank you.
Thank you. Again, it's an issue. To promote voluntary savings is painful for us, and as you can imagine, for low-income workers. So being able to have and to offer all the opportunities to save is important, but I'm afraid maybe it would be not enough for the future. So part of the role of the government will be to give some help with some source of income, but it will be very, very expensive at the future. No, but I am afraid that you have to be prepared for the future. We can implement different kind of incentives, but this is like a trial and error. So you must innovate, you must adapt to the workers, to some technological advances maybe that will be cost-effective, this kind of products. But as a government, I guess that we have to be prepared for the future. Maybe with some, we were discussing about some kind of seed bonus, seed bond. For example, you as a government put $500 per e-citizens when they're born. But with 60 or 65 years to long term, just to maturity. At that time, you will see who needs the specific help from the government. Just to be prepared, but just an idea. No? But the thing here is that we have to be prepared for the future. Not only the citizens giving this opportunity, but also from the government trying to have enough money, or maybe some money to help them. But we must offer all the opportunity and be prepared for that in the future.
Just a very quick thing on the convincing people and what will I get back and will it be the same as the government? I think financial education and being very specific about it can be quite tough. But I think it would be well worth just constantly stressing the message that the old age solution is public, private, work, family, and just some simple messages, and there's no choice. So it's not really a technical argument, it's some mixture of the four. And I think most people can get that, and that's the kind of challenge to people, rather than exact formulas and where the money is going to be invested, which is usually kind of beyond people.
Thank you very much. Pablo, thank you very much in advance for sharing some of the view of the OECD or recommendation on these issues. Can Pablo has micro, please?
Hi. Good morning, everybody. as we discussed yesterday, one of the key recommendations of the OECD is to design pension systems in a way that are completely inclusive. So they are they have parameters and they are designed in a way that everybody has access to them. Unfortunately, nowadays in most countries, and this is one of the issues of informality, but also for migrant workers, is that the pension plans are designed in a way that there are vesting periods, there are income limits, there is also the problem that was discussed yesterday about portability. So they do not allow many people that have, as I mentioned yesterday, non-standard forms of work to have access to save for retirement. And this is very important. Also, when we talk about policy, this is a key issue, but when we talk about policy, as I said yesterday, we need to distinguish between, when we talk about informality, they don't save for retirement, as everybody has been arguing, but why they don't save for retirement? It's just because they don't have to, like the self-employed, and this is one key issue, because as we look in many countries, there is a lot of people that move from self-employment to formal work, and it's very difficult to keep track of them. The digitalization is an issue, but it's very difficult to keep track of them, and they don't save for retirement. And then the other reason is because the capacity to save is low, as it was presented here, or basically because they just don't want to pay. They are trying to trick the, if you can say trick the society. But the issue that was raised, platform workers and all the different type of gig economy and all these type of jobs, and the flows between non-formal worker works and formal worker work makes this extremely difficult. As you mentioned, dedicated plans, like some countries have done, is very important to allow the whole issue of, that was also mentioned here, erratic income streams, temporary and seasonal work. If you don't create plans for all those people to be able, gig economy, platform economy, temporal, seasonal, non-standard streams of income, and then they cannot save in the plans that exist. And sometimes it's not because they don't save, it's that they just cannot save. And of course, the idea that was put forward here also, that having special plans for people that can put €1, $1, one currency unit, is very important, because the actual plans that exist don't allow them. And so the issue of non-standard forms of work that covers all the ones we have been talking is essential. And for the very low income, there is the safety net, and it's important that they know there is the safety net, and the access to the safety net maybe can be linked to the fact of saving for retirement. And they will see that the saving, even if they only put 1 centime into their account, it brings them into this safety net that will cover them tomorrow when they retire. Elio mentioned the 65 plan they have in Peru, but they also have it in Indonesia and in other countries. If people feel that saving a little bit, that the plans exist for them to save a little bit in a very discontinuous manner, and the safety net will always be there to protect them, people will.
Thank you. Merci beaucoup, Pablo. Okay, the last one. Ah, no, that's not. I thought you were raising your hand. So we'll close now the session. So please join me for a big applause for our panelists. Thank you very much.
Can we give them another hand as they go back to their seats? Thank you very much. Thank you. So now we have come to the end of session 4. We still have one more session to go, but we'll do that just after lunch. Just some announcements before we go for lunch. I'm sure as you were coming in, you would have received this. If you didn't, please, as you exit, pass through our registration desk to receive our consumer education game, which we believe will also help towards consumer education. We have that at our registration desk as you exit. And also, as I announced earlier in the morning, that you should indicate at the registration desk again if you will be available tomorrow, so that we can also work around the excursion plans that we have that will help us in terms of determining the numbers. So if you can indicate that. We also have another dinner tonight. Mr. Rinald, I'm sure today you are likely going to lose the medal probably to Indonesia. You want to win the dancing competition tonight, so make sure you bring the right shoes. So we have the dinner, a bush dinner so we call it Chipala Bush Dinner. That will be from 6:30. We are hoping that we'll finish the next session early so that we can go back and refresh. So we are hoping that we are going to have the dinner from 6:30 tonight in the bush. We'll have the fire, and the wildlife will be watching over us as we are having the dinner. So let's be prepared to come to the dinner tonight. And before I invite the commissioner just to say, or the deputy minister, yeah. Okay, so the deputy minister will be leaving after lunch. So he wants to say just a few remarks before he leaves. But as he comes through, I want to advise that we'll be breaking for lunch soon after the deputy minister has given his remarks. So we go for lunch and make sure we come back on time so that we finish the last session on time. Thank you very much, Deputy Minister, sir. You can come through.
Thank you. I could hear a few tummies growling behind me, so it will be brief. I was about to just quietly slip away, and then Madam Commissioner asked me to just bid farewell to this very diverse and highly knowledgeable group. Would like to thank you, especially all the visitors, for coming and gracing this occasion. This knowledge exchange platform has been extremely beneficial to us as Zimbabwe, and I'm sure to everybody else. And I do anticipate that we'll continue to have such engagements, especially in a changing environment like we have here in Zimbabwe, where your informal sector is becoming the bigger part of the economy. I do hope that in that particular regard, as regulators, you can come up with solutions, you can come up with frameworks so that we're able to encompass and include everybody to save for the future. With those few remarks, I thank you and I bid you farewell. Thank you.
My last announcement. So the dinner is not a walking distance. And also remember that we are around a national park. So we want you safe. So we have transport that will be provided, the usual bus that will pick you up to the dinner. It's very close by, but we have transport provided. So you will be picked up at 6:15. Make sure that you are by the foyer. Thank you very much. Let's break for lunch and come back at, we'll do 2:15 latest. Thank you.